Okay, hi everybody. This is episode number 11 of the physics of Bitcoin. We usually meet um, every Wednesday this time. And again, as a quick introduction to the show, we usually cover different topics about the math, the physics of Bitcoin. Me and Stephen have a background in physics. We have both PhD in astrophysics, and we have a kind of interesting careers. We did other things besides astrophysics. I went to neuroscience at a certain point. Stephen went in uh, studying, computational issues, right? Stephen,
Yeah,
what
sure. High performance computing and
high
science
performance
engineering,
computing, science, and engineering for different organizations and companies. So we have looked at data for decades and used many different tools to analyze the data in a scientific way. And the idea in our common approach is that we want to do the same thing with Bitcoin without using, some of the tools that people have used to analyze markets, like these TA tools that they are not really reliable and consistent. So we give a different angle and understanding in terms of what Bitcoin is, why Bitcoin is behaving a certain way. Okay, so we do have an agenda today. Basically, we are going to cover, first of all, given what is happening with the market, we do want to give a um, short analysis of the market based on our indicators, and then Stephen will continue with his analysis of the Hurst coefficient and what we can learn from it. So let's look at the market. So I'm showing on the screen this indicator. Let's see if I make ourselves smaller. There are many different way. Maybe this one. Yeah. Okay. So this is one of our indicators. I created these power law based indicators. This one is trying to show what we call the bimodal nature of Bitcoin, the fact that the Bitcoin seems to have a bimodal behavior where we spend almost an equal amount of time below the blue line. The blue line represents the general power law trend. So it's kind of a compromise between the large deviations that happen during the cycles that we have seen in the past, and this white line that you see at the bottom, that is what we call the support line. Probably the real power law, if it is a real power law, is that support line that seems to be determined but by fundamental like the growth in adoption, the hash rate, and so on. But because we spend a relatively small amount of time uh, on that support line, but we tend to be in these regions that are relatively confined. So about 2 years in this region between the blue line and the support line. So that is, and we kind of follow almost perfectly the power law with some fake out that this is what the term that Stephen has used in the past that I like. So while we tend to stay within that band, there have been a couple of times where we went above the blue line and we usually have a correction after it. And so this is what is shown in that green area. And then there are about 2 years where we go above a blue line. Now, we don't need to use a blue line. We can actually use some more sophisticated methods where we can, for example, there is this tool that is called the hidden Markov model, where basically you are asking to find, based on how the uh, dynamics of a price acts, to define states. And you can ask to, the only input is basically the data. The data is already detrend it through the power law, and then you are asking the algorithm to find 2 or maybe even 3 states, and these regions can be identified in that way. But to make it simple, it's very similar to separate the data according to being below or above that blue line, even when you do it with more sophisticated methods. And then there is a transition region. Usually, when we cross that blue line, and it's not a fake out, and fake out means it is within that 2 years where we are in that green area. After these 2 years, and that period ended in December of last year, we go to this regime where we have 1 year of a bull run where we do much better than the power law. Then there is a major correction that brings us back to the support. This is what happened in the past. And it did seem for this cycle, we did something similar where we crossed the blue line. We stayed there for quite a bit of time. In fact, we kind of follow it pretty well. You can see how parallel that white line is to the blue line in average, right? And it seemed almost the blue line was some kind of a support. And then, we broke that support in the last few days, and we had a pretty steep correction. You can see that almost straight down line. And some people got surprised by that. There is a lot of negative sentiment right now. Now, the first question is, did this ever happen in the past, right? Because usually we stay above and we don't go down. Now, that is true. For example, last cycle, we didn't do that. Once we went above, we went in this red region. We stay in the red region for about 2 years until we had a correction, right? The bear market started. If you go in the past, so this was another fake out, similar to what we had this cycle, for different reasons. But so there was one instance where this happened, right? This was the cycles in 2017. So we entered this red region. We actually had a pretty aggressive behavior. We already see. I will tell you what I think the major differences are between these. Right? Notice how in this bull market, in this cycle, we were very, very close to the support line. Right? In fact, we followed this middle ground between the middle power law and the support line. We stay there, all basically oscillating around this green line, which it represents where really most of the action happens. Me and Stephen have shown this several times in several ways. And in fact, going to the support line, it's kind of an extreme case, right? It's a support line, but at the same time, we barely touched it here. Then being an extreme, right? In this case, below this green line, it corrected up, and then we continue to oscillate around it and close to the time of the bull market with transition. So all these could be considered part of a transition period, pretty steep transition. We stay there for a time, continue this bullish behavior. Then there was a correction that actually brought us down. Notice, again, because this is an unusual behavior during this period, the market responded with even more aggressive push up, and then we continue the bull market. Of course, there are always some corrections. Once we have a continuous bullish behavior, there is always some kind of retraction. Then again, right, this is how the market works, right? Mostly because one of the things that needs to be understood is how market works, right? If there is somebody, if the price goes up, and so somebody is buying to push the price up, somebody is also selling, right? So if you sell too much, then a certain point and you are exhausted the number of buyers, the price will correct, right? And you need that correction to get more liquidity, and then the market can continue, right? Because people who didn't want to buy anymore here because we kind of exhausted the number of buyers, so we needed to find buyers over there, and this is why we corrected, right? These are very important mechanics that people need to understand on how markets work. So same thing here. Probably the market was exhausted and need to find some liquidity, so the price was pushed down here. But it did happen one time, so we cannot say that this never happened. It usually doesn't last long, right? We don't stay. Once there is this correction, the market almost immediately reacts by pulling up, and we can see what happened also in the other cycles. Now, this happened only one time, because usually once we cross here, even when there are major corrections like this one, it's because we went so much above this blue line that even with the major corrections, we don't cross it. It's all statistics, so it doesn't mean that because we didn't cross it, it never happens. The question is, we usually need to recover to be really classified as part of a bull run. So this is the first thing to notice, right? So what we're seeing right now could be part of that. A partial explanation that I mentioned before. Now, we are trying to interpret, we are trying to make sense, right? And the scientific approach, at least in my understanding, and Stephen maybe can correct me on this, but is, it's kind of surprising to me when people say, oh, you are using the past to predict the future, like if it was a bad thing. So what else should I use? If I knew the future, I didn't need to predict anything, right? It's the only thing I can do. I think people mean, well, there is not much to predict by using the past, because it doesn't mean that it's going to repeat. But it's the only thing you have, right? The idea is to find irregularities that seem to be Bitcoin seems to follow, and then see if this irregularity help us to understand what is going on. And this is why we compare the past with the present, and we make some projection to the future based on this regularity. This is all what we can do. And it works most of the time, right? The power law is an example of that. The power law is not broken right now. We are continuing to follow the power law. If you look at, I'll show you in a moment how the 4 years moving average looks like. It's on top of the power law. They are one and the same, basically. So the power law general trend is still there. And this is one of the things, it's kind of a backbone of our analysis. It's more about understanding how this bull market is playing. There are several things that are different. One of the things is when we had some of these fake outs, like this one, right, where we went above the power law and then there was a correction for whatever reason. We say we think it's due to this. It was due to this event plus token affair. You can look it up, and you can also watch previous videos where we explain why these seem to be associated with this event. We had a correction, and this correction brought us to the green region. Then after that, we had even a more bigger corrections that actually brought us almost to the support level. So that it was almost like a reset, right? It put everything where it was supposed to be. Then the price stayed close to this region, and then we had a bull market after that, right? So we got a lot of liquidity and a lot of buyers that were okay to buy the price, to buy Bitcoin at this price, and that actually it's almost like the fuel that allowed us to continue to go up. Also, if you look at global liquidity, we had plenty of global liquidity to support this market. In fact, what happened is that we had an early top, and then later we had a second top, where usually we have tops at the Q4 of this bullish year. This is different because mostly of the ETF action that didn't happen here in the middle of this 2-year cycle, 2-year component of a cycle. it happened a little bit later, and we did have a correction. It brought the price down to this level, but we didn't have a COVID to reset everything, right? Because the entire idea, the theoretical idea, if this theoretical idea is correct, is that we spend a lot of time in this region, these 2 years, and then we started the bull market. So this kind of could have messed up things in the sense that we kind of went a little bit too high relatively to where the beginning of a bull market is. And this is why, there was not enough momentum. Maybe, the election seemed bullish, many things happen that maybe change the environment for crypto and Bitcoin in particular. And that kind of pushed the price up, but it was a little bit premature, right? And this is why we couldn't continue the bull market as we did it initially. And this is why the price went kind of stagnated. Usually when something like that happens, you have like a narrow band with a lot of people putting orders above and below that narrow band. And the price, it takes very little to push the price in one of the two directions. But if you don't have fuel, if you don't have a lot of buyers that are committed to a particular level of a price, it's very difficult to continue a push up, right? So it was kind of more likely that we needed this correction instead of continuing up, unless there was some kind of large movement of capital or whatever that supported this. So this is what happened. If you look at graphs of local liquidity, you can see very strong volume in all the different futures type of orders that is around this price, around $44,000, something like that. We kind of almost eat up all that liquidity, and there is not much left. If we will have to go all the way to something like $65,000 to go to the next level of liquidity. So basically, we are running out of buyers, and that means you cannot continue this sell. So I think we are going to stabilize. Now, are we going to see a push up, like a strong reaction? We will have to see. Let's watch what happens. But it seems the price is stabilizing. The other piece of news that is interesting, so this is not, local liquidity relative to Bitcoin, is more like global liquidity. So I mentioned in the past many times this graph where, we started to see this correction that I mentioned before, from 70K to 55. It took many months to do that. And what was also nice was that the liquidity was going up. And I thought that somewhere here they were going to cross, and then, the liquidity was going above the price. That was all good, because if you look at what happened in previous bull runs, we had this cross. Like, for example, we needed to have that correction due to COVID to actually create this crossing, between. So the purple line is a model of the price of Bitcoin based on liquidity, and this white line is the price itself. So there was this crossing, right? And the liquidity model stayed above the white line for most of the, for the bull run. In fact, actually was, when we crossed again, was almost an early warning system that we were pushing the price too high. And then, of course, there was a correction. And this we can see that this happened every single time we had a bull run. We always have the purple line above the white line. But this time was different. And, I always question these. And some people criticize me saying, this time we have the ETFs, we have sellers. And they say, I don't know if the ETFs and sellers, by themselves can push this up without, the global liquidity supporting this movement up. This is why I have this question mark, right? That I have been keeping this for a long time. So at a certain point, it was a reversal, right? The price went up, the liquidity went down. And now we see again this meeting, going in this direction where the price is having a correction, the liquidity is going up. Now, not necessarily we will continue to go up in this direction. Hopefully, this actually starts to go even faster up. We don't need, if this was followed, but I don't think it is going to happen, we will have to go all the way to 54, right, for these two things to meet. But this is more like symbolic of somewhere here, maybe they will cross. I don't know if this is what is necessary for the bull market to continue, but at least the two need to come closer to each other. So, this is one of the things to keep an eye on. So I don't know. In general, we say this correction that we have seen was almost expected after all this flatlining, of the price, and there were a lot of orders that were there that were waiting for the price to correct, and we basically consume all of them. I can show you some graphs of this liquidity, where it's very obvious that is what is going on. But right now, I think the market is absorbing these ideas, right, of the tariffs. Like everybody's aware that this creates a lot of uncertainty in markets, right? And so hopefully this correction is a positive thing, because it will give us kind of a fuel of what is needed. Remember, every time somebody's selling, somebody's also buying. So that means all these sales were covered by a lot, some kind of buyers, probably or institutional buyers, that thought that this was actually an opportunity, right? And the price is not going further down, at least for now. So it's a relatively good. I know people don't like when the price goes down, but I think it's actually probably healthy that we had this correction. I'm trying to look at in a positive fashion this event. What do you think, Stephen?
Well, I don't have too much to add except, keep your eye on the long-term ball. And that's the power law. And, that's an expectation of doubling every couple of years, right? And we've had a big run up. We ran up a factor, 5 plus since the end of 2022. So most people are pretty far ahead. Some people have been profit taking. What you want to do is understand where you are and just, play to those conditions, but keep your eye on the long term. And right now we're slightly above the trend. If you take a median quantile regression, you'd get about 80,000. But anyway, we're in that transition zone. We're not in a bad place at all from a price level. And, it's not a place where you want to be panicking and selling, that's for sure. It's a place where you might want to add a little bit to positions. And you just adapt to what the market reality is.
Correct.
So, yeah.
And this is why I'm showing this graph, because, if you are thinking long term, so we are averaging over 4 years. The yellow line is the average over 4 years. Averaging over 4 years allow us to decrease the importance of these bubbles, they kind of almost smooth out. You can see that in this particular moment, the power law and the 4-year moving average, they coincide. That is basically where we found this support level, right, for the power law. And that price is kind of close to $40,000. That is kind of our backbone, right? So if you're actually looking at the long term, you don't care about these fluctuations, they are basically meaningless. But some people are interested because they want to maybe rebalance their portfolio. They want to know if we are in a bullish market, if we are in a bearish market, all kinds of things like that. I'm not ready to say that we don't have a cycle anymore. It's a different cycle from previous times, I think. because maybe the type of players that are acting right now. We have sailors, we have the ETFs, etc. I don't think the 200 target that we mentioned many times at the end of the year, quarter four, has to be is impossible. We are still possibly going there. I think if you are a Bitcoiner in the end, what really matters is the long-term trajectory. That is our reference, and that is, if anything, is actually even stronger now than before.
Right.
Okay. On Friday, actually, I will do a more specific market analysis. I will show you a couple of things. For a moment, I can show you maybe, and then I will leave the discussion to Stephen. Let me see if I can find. Yeah, so kind of I took a snapshot of these. I don't have a live picture of these graph. It's an indicator that is pretty nice indicator. It's a liquidity indicator. This is not global liquidity, it's local liquidity. It shows different futures contract with different type of leverage. These are, I think, up to maybe 10 pair that are pretty aggressive leverages, but not the crazy 100 pair. And you can see what I was describing before. Actually, this liquidity was building up all the way just before. I should have cut it off where I had prices on the right, but you kind of know more or less where we are, right? Because these are basically the last 2 months of action, 3 months maybe, including 2.5. But you see here, starting at the end of the year, we started to build this liquidity. So the liquidity here is indicated by these bars, these colorful bars, and the color indicates the volume, how much of these. Basically, these are orders that people place, hoping that the price corrects there, so they are ready to buy when the price arrives there. And you can see people started to think that there was going to be some kind of a correction, even if we added this run up right to the all-time high just before the end of the year. We reached what, 108, something like that, right? People were already hoping, they say, for a correction, right? And they were putting a lot of orders. Now, there were orders to sell above, but actually more orders to buy below, right? This is why you see these more and more intense colors with the order to buy below. And after the price didn't do much for a long time, the build up started to be bigger and bigger and bigger. And you can see as the price started to correct, more people wanted to put orders there to buy the dip, basically. And that is actually a good sign, because it means that people were okay with that price and thought of it was a big deal, a good deal, right? So there was a lot of activity, a lot of buying at the 84,000 level, 85,000 level. And we end up, we go all the way to basically 82, 83. And these are becoming less and less volume there. And below that, it's all blue, dark blue. There's nothing, like people don't expect the price to go much lower than that. And this is why you're kind of seeing the market stabilizing. But we need to keep an eye on these liquidity levels. So, all right, are you ready with your presentation?
Yes, I'll share screen. How's that?
Okay, let me activate it. Looks good.
Okay, great. So this is part 2 about Hurst exponent analysis, and I want to go in a bit more deeply, and it further validates what we showed last week. For the people who were here last week, a few things will be a little bit repetitive, but there's a lot of new information here too. I want to catch up, new viewers on what the Hurst exponent is and the general background as well. So the agenda is, first, I have this little fun thing, physics of fiat, an analogy with special relativity. Don't take it too seriously. It's just kind of for fun. And then we'll revisit the efficient market hypothesis slide, and we strike it out because it doesn't work for Bitcoin. It does not adhere to EMH. And then we'll show the Hurst exponent analysis with two different techniques. One is called the rescale range technique. That's the R/S. And the other is called de-trended fluctuation analysis. That's the DFA. Other people have applied Hurst exponent analysis to Bitcoin's price history. And what they have found is indeed there's persistence in trending, but the values they get are moderate. They're around 0.6. Now, 0.5 is a random walk, and 1 is very strongly trending. So they're finding moderate trending, but they use a different technique. In this process, you have to basically take out the mean behavior, which we call detrending. And they usually do that with something like a moving average, and then analyze the residuals. And what we do is instead we detrend with the power law. And with that, we find much stronger long-term persistence is evident, and a very strong trend apparent, over the long term. Also, it appears that the Hurst exponent peaks over a year sooner than the bubble price. And we had peak in the middle of 2024, it appears. And so that suggests that the bubble price should not peak until after the middle of 2025. We'll look at that in more detail. And then there's something called multifractal behavior, which is the behavior of this exponent when you look at small scale fluctuations and when you look at large scale fluctuations. It's quite an interesting result. And it has both trending and mean reversion components to it. So let's dive in. So this one is the fun part about looking at an analog with special relativity. You may recall that if your spaceship goes at some significant fraction of the speed of light, that clock's slow, you don't age as quickly as people on Earth. Well, also, the earthbound observer thinks your spaceship has shrunk in the direction of travel. Now, we have the same shrinkage in the value of our money with fiat. And the growth of the M2 money supply over long periods of time is about 7%. So I've just built a table using a 7%, kind of compounding. And what you see is that in the second column, the M2 supply would go up by a factor of 2 over 10 years, 7% compounded for 10 years, it would double. So, if it's 20 trillion, a few years ago, it would be 40 trillion, 10 years after that. And right now it's something like 22 trillion. And the cumulative inflation is shown in the next column, and it accumulates to 97%. So basically, your money's worth half as much. And that's shown in the fourth one, the inverse of the value, which is the loss of your purchasing power. Now, you can use the formula of this Lorentz contraction that you get for rulers and for spaceships moving at relativistic velocities. And you can say, at what speed do I need to be traveling to have that much shrinkage? And it turns out for 7% shrinkage, you need to be, in the next to last column, you need to be traveling at 0.36. This is the ratio of light speed. So you're traveling at 0.36 of light speed, what we call beta. And then, as the inflation continues and the value of the money drops, it becomes a higher and higher number, right? So eventually, after 10 years, it would climb to 0.86. You'd be traveling at 86% of the speed of light would be necessary in order to shrink the size of your spaceship as seen from an observer at rest by a factor of 2. And then for added, I would say, levity, we've calculated the acceleration that you need to get to those speeds if you have to do it in 1 year time interval. And you'd have to accelerate, the first year, you'd have to accelerate at 0.38 g, so 0.38 of the Earth's gravity. But you have to keep increasing the acceleration. It gets harder and harder to accelerate your ship because the inertial mass goes up with this factor that we call gamma. And if you look on the left-hand side, we've got the equation there in the third bullet. If the velocity is v over c at beta, so some fraction like 0.36 going up to 0.86, the gamma factor, which is the ratio of the amount that you shrink, is just the inverse of the square root of 1 minus that velocity squared when the velocity is put in terms of speed of light. So the takeaway is that you have to not only run faster and faster, but you have to accelerate harder. And it's kind of an analogy to what people have to do in the economy. They have to run faster and faster and maybe even accelerate harder in order to keep up with the cost of living and rising prices. Fortunately, we have Bitcoin as a standard ruler. And so we can just step out of the system, ruled by a different set of equations, which are power law.
We lost you. We lost you.
All right.
Okay, back. You're back.
Okay, good. Then I'll reserve. Okay, this is a reminder about the efficient market hypothesis. And there was a literature review conducted a few years ago by these authors. They summarized 25 different studies that people had done about Bitcoin price behavior. Many, many techniques were used that are common in econometrics, like this Garch type model and the ADF tests. There are two that we're using today, which are the detrended fluctuation analysis and the classical Hurst exponent test, which is this rescale range. They only looked at prices and correlations with other assets. None of them considered the power law theory, except the log periodic power law model uses a power law in a different way. So it's not the same as what we generally talk here about the power law. But they were aware of Metcalfe's law. And the log periodic power law model really just models the bubble portion and how bubbles get faster and larger and waves get closer together. So it's a different application of a power law. Out of these 25 studies, 20 of them found that Bitcoin does not adhere to efficient market hypothesis. Okay, and a reminder on what the Hurst exponent is. In the classical technique, you first detrend the residuals. Others have done it with moving averages. Typically, I do it with the power law. And so we take the log of the prices, we subtract the power law, and our residuals are log price residuals after you remove or detrend with the power law. You then have to calculate, in some window, you have to calculate the range in the way that Hurst defined it. And that range is really requires you to take all the partial sums of the residuals. So you start from, if your window's in, you take the partial sum of 1 and 2, and then 1, 2, and 3, and 1, 2, and 4, all the way up to n. And you find the maximum, and then you find the minimum, and you subtract the difference of those, and that's your range. You also take the standard deviation, so you normalize the range to the standard deviation for that window. And what you find is that you can model by the window size to some power law, H. That is known as the Hurst exponent, and generally it falls in the range of 0 to 1. 0.5, 1/2 is a random walk. Above 0.5 means trending. Below 0.5 means mean reverting. So above 0.5 is indication of long memory effects, even in the residuals. So to get the first analysis, I looked at weekly and then daily data. And I did this for both gold, Bitcoin relative to gold, and Bitcoin relative to the dollar across the full, 15 years of price history. And we found very, very strong numbers. Basically, we found with the weekly 0.89 and with the daily 0.97. So very close to 1, so indicating very strong trends. And one should believe the daily result more than the weekly result because this technique requires you to have a lot of data. And you want to have preferably over 1,000 data points. So we have a highly inefficient market. It is not mean reverting in the long term. It has mean reverting phases, following bubbles, but the long-term power law trend and the residuals are not mean reverting. By the way, if you take 10 years of SPY ETF for the S&P 500 and look at the daily prices, you find a Hurst exponent of 0.18, which indicates very strong mean reversion. Now for that, I did a DFA analysis, and I'm going to show you that in a moment for Bitcoin. And I did not detrend by power law because SPY doesn't follow a power law. It follows an exponential curve. So that's a constant compound annual growth rate. So that's what I use to detrend in that case. But typically that's what you see for stock prices. Normally they would be mean reverting. Okay, so this is the original method, the RS method. This uses 1-year windows and quarterly time steps. And this also uses hourly data because we're not now looking at the entire 15-year range. We need more data. We're looking at 1-year windows. We're time stepping by a quarter year and repeating the calculation for the next 1-year window that's 1/4 of a year removed. So the Hurst exponents are all the dots. Those are color-coded by what zone, price zone Bitcoin is in, whether it was in the core or the bubble zone or the transition zone. And you will not see the Hurst being red at the peak. It's more likely to be green because it's leading the price, right? So the green dot, is about a price that's below on the soft blue line, right? You just project that down. And the first Hurst peak, which happens at 3.5 years, that's referring to a time when, the Bitcoin price, was only about $10 at 3.5 years and was in a rather flattish zone. So it was in the power law core zone. In this case, I've refined the data by not using one single quantitative regression for the entire series and subtracting that. What I've done is what you would do if you only had the data up to that time. So I've just repeated the quantitative regression at every point that's plotted here and only look at the data up to that time in order to see what the residual values should be. And so it's more predictive. It's not backward looking, the way that I've done it. Overall, what we see is, again, the values are always above 0.9. They're very high, indicative of persistence and a strongly trended market, and they're only slowly coming down with time. It still remains very high, and we've got an excellent edge. The next slide just repeats with smaller steps. Again, the window is 1 year, but the steps now are 1/8 of a year. So you just see twice as many data points. It looks generally similar, but the details are a bit different. The other thing I've done is I've added arrows that I've drawn from the prior peak of the Hurst exponent down to the peak bubble for the largest bubbles, the 2013 bubble, the 2017 bubble, and the 2021 bubble. And here I've used the 2021 is a double bubble, right? But here I've used the first peak because the first peak actually has a bigger residual. So I view that as the true bubble. Its residual is 0.6 in the log relative to the power law, whereas the residual for the second peak is 0.5 in the log relative to the power law at that time. And then I have a fourth dotted arrow, which is a projection, and it's assuming that maybe we had, sometime in relatively early part of 2024, a peak in the Hurst exponent, and then you project that forward by about 1.25 years, because that's the average length of these arrows in time. Just project them down in time. Don't look at the length as they're drawn, but project them down in time on the linear age. And I show this in the next table. So this shows for the 3 bubbles, when the Hurst peak happened. So the 2013 bubble peaked in December of 2013, but the Hurst value peaked in June of 2012. The 2017 bubble peaked in December, but the Hurst value peaked in September of the prior year. And we had the earlier Bitcoin peak, which has the larger residual, and I call the true peak, was mid-April. And the prior Hurst peak was actually 21 months prior. So the average interval for these is 546 days. That's just about 1.5 years. So if we say that the last Hurst peak was that dot, that could change as we get more data, because we've got this 1-year window, so we can't see right up to the present. But if it were June of 2024, and you push that forward by the average amount, it's 1.5 years basically, then you end up December 5th of 2025, more or less. So that's pretty interesting. That accords well with Giovanni's date, which is in November, I think late November. Okay, this is the other technique. This is the DFA method, the detrended fluctuation analysis method, it's called. It does still look for a power law. The mechanics of it are different, but it's still a power law of, how things are fluctuating within a window, raised to the Hurst exponent, and that's how you solve for the Hurst exponent, is you do a regression on that. Again, it's hourly data. When you use this method, you're doing some fitting within your window that could be linear or could be quadratic. And I'm showing both graphs on this page. The larger one is the linear method. The smaller one is the quadratic in the lower right. And you're seeing, more or less similar, but somewhat different results with those. But generally in accordance with each other. One of the very interesting things is that we get very high values of over 1.4 in most cases. This is known as a super diffusive process, strong trend following with explosive behavior. And we certainly know we've got explosive behavior. If you calculate when the next price peak would be, it's sooner. It would be in August of this year, based on, drawing the arrows in the same way from the prior Hurst peak to the bubble price peaks and then averaging those. In order to validate this, you can randomize all the residuals and you can feed it through the algorithm. So you randomize them and you phase shift them and you feed it through the algorithm and you expect to get something quite different, and you do. You get a random walk. You get H equal to 0.51, which is right on top of a random walk. So that helps validate the method that we're using. Now, this is something that's different. It's a multi-fractal analysis. It does use a DFA technique, but it's a generalized Hurst exponent, and where you take the DFA technique and you're taking some root mean squares of these fluctuations, and normally you would, you'd take a square root of that, but instead you could take it to the 1 over the Q power, and Q here is called the fractal order. And the regular DFA corresponds to Q of about 2. And you're expecting to see, basically you're expecting to see, sorry, on the left-hand side, you're seeing small fluctuations. And what we see is very high Q values for those. And on the right-hand side, you're seeing fluctuations at the largest scales. So we see extreme persistence for the small fluctuations, the Q less than 0 region. And then we see a rapid drop as we go through Q of 0 and head into the random walk space, and then a continued gradual decline down to 0.3, which indicates mean reversion. It's applying to the large fluctuations. And we know when we get very large bubbles that they're going to have to mean revert before, very long. So that's what that's showing. The range being so broad, by the difference between the peak on the chart and the bottom of the chart is about 4. And so that indicates very strong multifractality, if you will. A lot of different behavior at different scales. Now you can redo this by zone. And I've done this in 2 different ways. First, I did it by just the power law core and the bubble zone by using the 0.5 or median level for the quantitative regression to sort the residuals. And that defines, below that is if they're negative residuals, it's the power law core. And we see similar shapes for the curves. They're not as extreme because essentially the bubble behavior has sort of been normalized to itself in this. But we still see very strong nature of the trend for the small scale fluctuations with values like 0.7 and 0.8. We see the transition as we get in the sort of Q0 and 1 zone down to the random walk, and then continued drop. So the long range correlations show stronger persistence for small fluctuations, and larger fluctuations decay faster, and that's more true for the bubble zone.
So one interpretation of this, if I understand it correctly, that the large fluctuations of a bubble are simply fluctuations that are proportional to whatever happens during the bubbles, right? It's nothing
Correct.
special. It's just
Correct.
one of the large fluctuations, the one we pay attention to, but it's not different from the other fluctuations. It's all part of this process, right?
Correct. And it's interesting that the mean reversion is quicker for the large fluctuations in the power law core, but those large fluctuations are not as large as the bubble fluctuations, right? It's normalized to what they are in the core.
I don't think it's, and we already show it, right? Because in a sense, we already show that when you are in that core place, you tend to stay along that middle power law, right? And any fluctuation in either direction will go and will be reverted.
Right.
While we're in the bubble territory, we tend to have almost like a log normal distribution where the large fluctuations are more common than they should be, right?
That's right.
It's less symmetric, so it's
That's
not.
right.
It's not. It's actually, in a certain sense, kind of confirming what we already show using different type of analysis. So it's actually nice that everything converges to the same picture.
Yeah. So if it breaks out to the bubble, you have stronger trending because the red line's above, and you have somewhat slower mean reversion. Again, the red line is above. So that's all consistent. Okay, but I also pushed it further and did it with the transition zone. And so I used the 0.4 and the 0.6 levels to sort between the power law core below 0.4, the bubble above 0.6, and the transition zone in the middle. For most of it, the transition is closer to the power law, except for the very smallest fluctuations. We've still got, a substantial range of about 0.5 from the left side of the chart down to the right side of the chart or more. And decline to 0.22 or 0.25 in the large fluctuations that revert to the mean region for power law core and for the transition zone. So I think, again, this looks consistent, and it's actually quite remarkable compared to most, price series that you would see. Okay, so let's summarize. 80% of studies reject the efficient market hypothesis. The Hurst exponent and method looks for long-term memory, for trending, for persistence. If you detrend with the power law, then the Hurst exponent is very high, greater than 0.9 for either the dollar or for gold. If you use the DFA method, you get even higher values, characterized as super diffusive with 1.4. So the alpha of Bitcoin is strong. Our knowledge advantage remains high. We have an edge on the rest of the world. Other authors have failed to use the power law foundation. So even people that study Bitcoin don't realize how strong this edge is because they find H of 0.6. And the exponent seems to peak around 1.25 years prior to bubble price peaks. The multifractal Hurst broken down by power law core, transition zone, and bubble zone shows that mean reversion is stronger for the core and that you see a higher Hurst exponent for bubbles, not surprisingly. Okay, with that, I will turn it back.
Very good. And you didn't include the most recent data, right? It will not be too useful anyway, right? Because these are all about long-term trends.
And on the next closing slide, which I forgot to show, I did have a link. I put up a Substack article on this 12 hours ago. Mm-hmm. So people can go search on, basically look at my X Twitter feed. I've got a link to it in there, but on Substack, Stephen Paranoid at Substack. So it's an article that has this content, basically.
Let me see if I can find it. You say that which one it is? Bitcoin strong persistent?
Right.
Okay. No. Where is the link, though? Because I see, if I click on your post, I don't see the link. I see a picture, but not the link.
Yeah, the name of the link is in the picture.
The name of the link is in the picture. Oh, okay. Let me type that because I want to put it in the chat, Stephen. Node. Substack. Yeah, okay. I will post it in the chat so people can look at it. Here. And I'm going to make the chat visible. Okay.
Good, that's it.
Yeah. So this is a link if people want to read the article. In fact, you should subscribe to Stephen newsletters. All right. I like all these analyses. So we already subtracted. I have a question. So we already subtracted the power law. So this means there is a trend over a trend, right? So there is
Right.
the overall power law trend, and in addition, there is some other memory that is not accounted for by the power law by itself, right?
The residuals of the power law are just the first time derivative,
Right.
which is
Exactly.
also a power law
Yeah.
of one
Yeah.
index lower.
So one will expect that, right? He will expect because, yeah, that is the cool thing about. So let me think about that for a second. So you're saying there is a trend that is kind of deterministic. And it's like saying, this is the position. And then you're saying, well, if I'm looking at the change of this position, of course, also that will be somehow deterministic because it's the velocity, and the velocity of something, the motion
Mhm.
of a falling object is a power law. The derivative of that will also be a power law. And so, yeah, it completely makes sense. um, so, yeah, you will be able to. This is why taking out the residuals, it doesn't even, you will not expect to see random behavior. This is one of the things
Right.
that many people actually
Right.
criticize because they don't understand power laws. They don't
A
understand power laws.
statistician can't understand this, right?
Yeah,
Yeah.
they will think, oh, I'm taking this trend, and because we are not used to deal with
Mm.
processes that have strong autocorrelation, they actually think it's a bad thing. But if your system has memory and is autocorrelated, it's actually a feature. It's not a bug, you know. And if there is something that drives the process for whatever reason, because, for example, it's a network or whatever, and it has its own mechanism, then your statistical methods are not really the best approach. You can still use statistics, but you have to understand it, uh, how to apply it correctly. If you don't, then your answers will be nonsense. Because if you're thinking, oh, I'm just going to detrend it and I'm going to get something that is supposed to be random noise, right? It's going to be random. You don't. If you have a power law behavior, the residuals will be the signal. Just now it's the derivative of signal, so it's the velocity is the
It's
change of the original
right.
signal. So you cannot apply your usual ideas of econometrics. This is part of why we have friction with some people that are more. We have this econometric approach that is not the right approach for Bitcoin. And we have demonstrated over and over and over again. You want to use things that are more similar to what we use in physics, that is understanding dynamics and changes and trajectories and things like that. This is why this approach from physics is really valid, and everything else is missing the mark, missing the point. Yeah, it's really cool. Yeah, the derivative of power law is power law, and the integral of a power law is a power law. So you cannot
Right.
escape it. You have to think in these terms. Yeah, very good, very very good point. All right, so I'm showing the questions. We can also highlight the ones that we want to answer. So John Smith is asking this question: what do you think the chances are that this bull market is in fact already over? I can answer, but do you want to answer too?
You go first.
I don't see signs where we are in a, because for the bull market to be over means we are in a bear market, right? I don't see signs of this. Um, this correction doesn't look like the beginning of a bear market, mostly because it's also a question of timing. Um, for a correction where again historically, when we have this bear market, we go all the way down to that support line. I'm not expecting to see that at this particular point. Now, if we have a lot of bullish behavior in the next few months and we reach our target and it happens in the right time and all the other things, then yes, we will be prepared to say, okay, this is the beginning of a bear market. So I'm not yet ready to say that. I do see the differences with previous cycles, so it's important to point them out. But it's possible that this correction is actually what we needed to get the fuel to support the bull market that is going to follow in the next few months. We need more clarity with this global situation, right, of the tariffs, because it's not just the US economy is impacting the entire world. I think markets hate uncertainty. It's not, okay, this is good, this is bad. It's mostly like, let's get over this uncertainty, and then once we know what is going to happen, we can still adapt to that. But market really don't like uncertainty, so was part of what is going on. Liquidity is a good sign. Liquidity is going up. It's very little liquidity if you break it down. When I look at the indicator, I can isolate the different contribution. US doesn't have a lot of contribution to this liquidity, so it's coming from somewhere else. If we see some liquidity coming in from United States, that will be further positive sign. But yeah, right now I'm not ready to say we are in a bearish behavior. It's just a relatively healthy correction, I think. What do you think, Stephen?
I think the chances that is already over probably less than 1/3. Various methods that we use to project when a peak could occur, and like the ones I've just showed you, are quite different, but are confirmatory of the methods that Giovanni uses. So we have that. We have this uncertainty, and I think a lot could happen in a few months. But this is a highly uncertain time for tariffs and budget. And so I think we need to kind of get through that and see how that resolves. And if we have some break in growth in the economy, then the Fed would be encouraged to step in and add liquidity. So they tend to be reactive. So it might take a general market break, to cause that. But the expectation is that they will be injecting liquidity during this year. And when they do it, they tend to do it in a substantial way.
Yeah. Let's see if we have some other question. Mostly good comments. Great work. I think this one. Then we can take this one, and maybe we are. Let's see. This one. Sure. Okay. Go ahead, Stephen.
Yes. Well, if we saw, so we check, how the power law index changes with time, and it's been quite consistent and stable for the past 8 years or more. And, we monitor that. If it really broke down in terms of long term, not the fluctuations due to the bubbles, then we would have to think about that. And one can do other validations. One is to look at the adoption. The adoption is a little more clouded now that we've got many different channels, for wallets to be filled in terms of ETFs, and we've got corporate owners that are large, like Saylor and so forth. So it gets a little harder to measure adoption, but there are ways to try to do that. Biggest risk, I suppose, something that's globally disrupting, like COVID was, or war, or something like that. But I think that even if we have those incidences, I don't think that breaks the power law model in the long term. I think the nature of Bitcoin is such is that it should continue to adhere to the power law model for quite some time. Eventually, one might get to saturation. How much wealth can be deposited into Bitcoin relative to global wealth? And at some point, you could consider that. I've done these Weibel analyses where you have some flattening, and right now we don't see any evidence of that. The power law is statistically just as robust as Weibel models with almost any sort of ultimate market cap. Giovanni?
Yeah, more or less the same. Maybe I will add there are different hierarchies of what is meant, that what do we mean when we say that Bitcoin follows a power law. One of the core things is looking at long-term trends like this, right? Um, because that is really what matters, right? When you are looking, basically, you want to eliminate this uncertainty, this distraction of the bubbles, right? They are an important component of what is going on with Bitcoin. All these analysis with Stephen just show right now shows that basically, even when we are in bubble territory, we are still following these long-term trends. It's just that there are larger deviations, and that are basically also these larger deviations are nothing else when they look like the other deviations. It's just that we pay attention because humans are like that, right? We have this in a kind of sense. We also respond to almost like if we were a log detector, right? We need to see large changes in the value before we react to it, and this is why we pay attention to these huge big bubbles. But if you really focus, you can see there are small bubbles all over the place. Um, so it's really fascinating that all these bubbles work together and all these flotation work together in a way that the noise cancels and there is like a long-term signal. And given that both of us have decades of working with these kind of things, right, distinguishing noise and signal, we are trying to look at a graph like this and say, yeah, there is a very strong signal. These signals continue to exist, right? Because there are, what does it mean? It means there are processes that are creating this signal that are at the core of what this phenomena is. These are the way of thinking of a physicist. Things don't happen by chance. When you see signal like this, there is a process that produces them. And unless there is some radical change in the process, you will not see something different. The process will continue. Now, of course, on a certain point, you run to natural limitations, like Stephen has mentioned, that is, we already demonstrate, both of us, that we do need a continuous flow of capital in the system to push it up. When people mention, oh, the ETS are going to change the story, and say that, well, it's simply what is needed to continue the story. Because if we don't see this inflow on the level of, at a certain point, I made the calculation, we needed close to $65 million a day, something like that. And I think you got similar numbers, right, at a certain point. And then these numbers will go to hundreds of millions and billions and so on. Um, you know, we will not stay on the power law. We need that continuous inflow that is going to be bigger and bigger, and then we will continue to see this scaling up, right? The power law is a story of scaling up in a very precise fashion. So right now, everything shows that we continue to work in this way. I don't see any weird behavior. The cycle situation is different because it's part of a theory. Like we want to understand the theory, what they call the power law theory, includes also a subsection. Let's call it the main story is the power law, and then there is a subsection that is, okay, what about the bubble then? And we explain many times what we think about the bubble. The bubble are simply natural deviations from the trend that happen when you have this bimodal way of the Bitcoin behaves. But it's possible that over time, that we already see signs that the bubble are becoming smaller, they are less relevant, that maybe we don't have that, that turbulent behavior like Stephen describes it. It becomes less and less turbulent. When, if you have an airplane that go very, very fast, there is more turbulent behavior. If the airplane starts to slow down, you see a more steady state type of behavior. So maybe we are transitioning to that kind of behavior, long-term behavior for Bitcoin, where we do see still corrections. They can be 10, 20, 30%, but we don't see these huge big bubbles. It's possible, but we will see. We will see. Right now, I will say that power law is as stable as before, with the big caveat that we do need to see scaling. That means, more institution coming in, maybe even at a certain point, and not necessarily now, but in the next several years, we need to start to see maybe even nation states investing in Bitcoin. That is what is required to go to these levels, because individuals by themselves, unless the entire world population starts to buy Bitcoin, but even there, we have limited resources. We need to see large institution, and it's still part of a adoption plan, because when an institution comes in, is made of their capital is made of contribution from individuals, right? Pension funds and so on. It's just another way of doing it, where it's more like large group of people coming together, right? This is what we need to see. So if that continues, I will say that the power law, it's the core of what Bitcoin does, right? It's how it behaves. So I don't see that change yet. We do have a lot of tools to tell mathematically, okay, we are not on a power law anymore. We are not following it. And, we will be, believe it or not, we will be the first one reporting that, because we stick to the scientific method, right? And if the data tell us something, we will have to accept reality. It's not that we are committed to the power law per se. We do want to understand Bitcoin. The power law is just a tool to understand Bitcoin, a powerful tool. But if Bitcoin does something else, then, we will have to see what it does, and the usefulness of models is also this, because you can compare before and after, right? Before Bitcoin has followed this, now it seems there is a deviation. What does it mean? Is it temporary? We call many times, if we have this thing called phase transitions, right? Maybe there is a phase transition where the previous behavior doesn't apply. But right now there is no indication for this phase transition. Do you want to add anything to this, Stephen?
Sure. I mean, this is a scaling property. So in order to understand that it had broken, we're going to have to wait another 16 years, right? We have to double our time scale from where we are.
Right.
Yeah.
I don't know. I don't know if I understand this question, but let me highlight it, and then maybe we can wrap it up. Let me see. I'll let you answer this question. I don't know if I understand it.
I have no comment on that. I don't.
Yeah.
I don't monitor those.
One has to be a little bit careful about these kind of things, right? Because there is this idea that certain numbers have almost like a magical power, like pi, for example. Like there is an indicator that is called the pi cycle or something, right? And it's only it's kind of useful. Maybe sometime we can discuss it, because maybe we can have an episode about how do we distinguish what we do that is using these mathematical tools, these things that, like we will, if we wanted to understand if Bitcoin data was a planet, was some physical phenomena, we will use the same type of tools, right? And this is what, let's say, the professional in the field will do. And then there are other approaches like, okay, moving average. Moving average are useful because they tell you in general what is the general trend, right? You are decreasing the noise, and in the absence of you finding a very precise pattern that has a long-term significance, the moving average is the best thing you can do, because at least you are kind of decreasing the noise and trying to see if there is some kind of general trend. And for some reason, this indicator called the pi cycle found two good moving averages, right? Moving averages are so always delayed, and by seeing their interaction between a fast moving average, over a certain number of days, like I think one is 111 days and the other 300 something, you can identify patterns, right? Because the fast moving average will react faster to things like tops and bottoms and so on. The other one shows more of a general trend. And when they intersect, it's a way to identify certain events on the chart. It turns out that for whatever reason, this, the creator of this indicator found this ratio between these two numbers being close to pi, but really it's close to 3, because you can fudge around where you can say, oh, I got this precise number of days for this average and this other one for this other one, and it turns out it's exactly like pi, right? Of the first 3 decimal place, of the 4th decimal place is pi. It's ridiculous, because I could have used 3 days more, 4 days less, and will still have work exactly in the same way. We call it numerology. This is numerology. There is nothing serious about. And if I call it pi, I can confuse a lot of people giving significance or importance, right? Because people think, oh, pi has to do with cycles, right? Because it's like in a circumference, and pi is an important number for the circumference. So people, it's okay to come up with, all right, this rough ratio between these two in the moving averages kind of tell us where the peak is and whatever. It's okay playing around with indicators in that way, but then call it in that way, emphasizing the pi, it's kind of scammy, okay? And so, yeah, I don't like that kind of stuff. So I don't know, this Euler number significance here, because it will be another number that it's useful in certain things, but if you just thinking as a multiple, and the multiple is similar to something else, usually that is a sign of numerology, that you're doing numerology, you're not doing math or science. So I'm not saying that Iceberg is doing this, but it sounds to me a little bit like that, right? So unless I understand better what you're asking, I'm just warning people to be careful about playing with these numbers that seem significant, and then basically seeing Jesus in a tortilla. That is not what science is about. Stephen?
Nothing to add. I'm in agreement. I would just say that Euler is the base of the natural logarithm, and we think we should think in log terms about the price. Don't think about the price varying by $1,000. Take the log of that and see how little that variation is, right?
Right.
It's a power law, so it's going up, in that fashion, and so I think people shouldn't worry too much about these pullbacks.
Yeah, even this idea of, for example, of a Fibonacci number, I never liked it, because yes, Fibonacci numbers come in nature and they have some significance, but when people apply it in this very arbitrary manner, again, it becomes just pattern seeking that our minds are very good at, but we tend to attribute meaning to things that are not meaningful, right? But usually it works in nature, because if we are on the side of seeing patterns where they are not, like we are hearing noise in a bush and say, oh, I think it's a tiger, and you hear, and you're making a mistake and it's not a tiger, at most you consume some energy because you're running away, right? And it's good to err on the side of caution and thinking there is agency where there is not, right? That is how we survived, and so we are basically nevrotic, and we think there is meaning in everything we see, But this is why the scientific method, it's something that help us to go through that, right? To go through the emotions, to go through these instinctive reactions that are good on the savannah, but are not good on the market, for example, or analyzing stuff mathematically, scientifically. It's great that we have this methodic system of going through step-by-step logical thinking, being supported by data, because it helps us to avoid, or reduce at least emotions, or seeing patterns where there are no patterns, and identify patterns where there are. So that it's great that humanity came up with the scientific method. Okay, guys, I think we did again, a nice episode. We cover a lot of interesting material and ideas. We answer your questions. We are more than 1 hour, so it's good. We can conclude here and meet next week.
Thank you, everyone, for watching.
Bye, everybody. Thank you.